In this module, we are going to discuss a number of accounting principles. These are the rules that underline how an accountant would record a particular transaction. Now, these rules are governed by two bodies, mainly the Financial Accounting Standards Board, FASB, or the International Accounting Standards Board, IASB. Both of them present the underlying principles that accountants should follow and deciding how to record a particular transaction. Now, according to FASB, the information should be relevant and faithfully represented of the transaction that took place. This information is communicated through financial statements. So information that is relevant is accounting information presented on the financial statements that would make a decision, that would make a difference in the decision maker's mind. Information is considered relevant if it provides information that has predictive value, that is, helps provide accurate expectations about the future, and has confirmatory value, that is, it confirms or corrects prior expectation. Faithful representation means that information accurately depicts what really happened. To provide a faithful representation, information must be complete, neutral, and free from error. Now, there are some enhancing qualities. That is, comparability. Results when different companies use the same accounting principles. Now, that is essential, so that we can compare financial statements across different companies, different countries. Information is verifiable if we're able to prove that it is free from error. Information has a quality of understandability if it is presented in a clear and concise fashion. Information consistency means that a company uses the same accounting principle and methods from year to year. They do not change from one year to another. And also, accounting information must be timely. Now, there are some assumptions that underlie the financial reporting. First of all, there's the monetary assumption. It requires that only those things that can be expressed in money are included in the accounting records. There's the economic entity principle that states that every economic entity can be separately identified and accounted for, and that entity is separate from its owners. Finally, the periodicity states that the life of a business can be defined in artificial time periods. So we're going to expand on the periodicity one a little later. There's also the going concern. That is, we report these activities with the assumption that the business will remain in operation for the foreseeable future. And the accrual-based accrual-based method of accounting. Transactions are recorded in the periods in which the events occurred. Now, some principles in the financial accounting. Measurement principles. There's the cost principle, or the historical cost principle, which dictates that a company records assets at their cost. There is the fair value, indicates that the assets and liabilities should be reported at fair value, the price received to sell the asset or settle a liability. Full disclosure requires that companies disclose all circumstances and events that would make a difference in the financial statements. For example, if you knew as the accountant that there's a pending lawsuit that might affect the assets of the corporation you were working for, full disclosure principle would require that you report that as a note to the financial statements. Now, constraints in financial reporting is the materiality constraint. Materiality simply means if the item's so small, it won't make any difference to the decision maker, just ignore it. The cost constraint weighs the cost the company will incur to provide that information against the benefit that that information would provide to the users of the financial statements. Now, here we have some concepts you can test. Here are some FASB accounting standards: relevance, faithful representation, comparability, or something. Match each of these items above with the description below. Ability to easily evaluate one company's results relative to another, well, that's comparability. Belief that a company will continue to operate for the foreseeable future, that's the going concern. The judgment concerning whether an item is large enough to matter to decision makers, materiality. The reporting of all information that would make a difference to the financial statement users, that is full disclosure. The practice of preparing financial statements at regular intervals, periodicity. The quality of information that indicates the information makes a difference in a decision, relevance. Belief that items should be reported on the balance sheet at the price that was paid to acquire them, well, that's the cost principle. The company uses the same accounting principles and methods from year to year, that is consistency, and tracing accounting events to particular company's economic entity. The desire to minimize errors and bias in the financial statement, faithful representation. Reporting only those things that can be measured in dollars. Well, that's the monetary unit. So you see how these principles relate to certain business transactions and activities. Now, keep in mind that we have to divide the economic life of a business into artificial time periods. This is called a periodicity assumption. Now, the rule is, or the regulations are, that a company must present financial statements once every 12 months. Many companies produce interim statements quarterly, every 3 months, or semi-annually, 6 months. But they must have a 1-year time frame. Now, that is called a fiscal year, as opposed to a calendar year. A calendar year is January 1st to December 31st. A fiscal year is the first day the company started business. Now, the fiscal year can be the same as the calendar year, but quite often is not. But nevertheless, the fiscal year is a 12-month period. It could be from March 1st all the way around to February 28th. Now, a very important principle is a revenue recognition principle. This is why the accountant does adjusting entries at the end of the accounting period. Here you recognize revenue in the accounting period in which it's earned. If you have not received the money, that does not matter. If you have provided the service or sold the product, you've earned the revenue, and you therefore must recognize it in that time period. Expense principle is the same thing, only it applies to expense, and let the expenses follow the revenues. So if you record the revenues in that period, the expenses you must record in that same period that match that revenue you earned, even though you didn't pay the expenses until a later accounting period. This all has to do with what's called the accrual basis of accounting. Now, accrual is simply an old Latin word, means it happened, but it's not recorded. So, the accrual-based accounting, transactions are recorded in periods in which the events happen. Revenue are recognized when earned, even when cash is not received, and expenses are recognized when incurred, even if cash was not paid. An example of that is as follows. The cash business, people think accounting, you just record cash when you receive the cash and expenses when you pay. That's not the case. Suppose that Fresh Color paints a large building in 2011. In 2011, it incurs and pays total expenses of $50,000. It bills the customer $80,000 but does not receive payment until 2012. Well, if he was on the cash basis, look what the financial statement would look like in 2011. Revenue? Nothing. Expenses? Yeah, I paid $50,000, so I have a net loss of $50,000. In 2012, if he did no other work, revenue of $80,000 and no expenses. And therefore, I'd have a profit of $80,000. Now, that's ridiculous. And it's a timing issue. So, the accrual basis simply states, recognize revenue in the period it incurred and match those expenses that were incurred in earning that revenue in the same time period. So that's why you have 2011 an income statement that would read revenue 80,000, expenses 50, net income 30, and nothing in 2012. So that is the reason for us as accountants to report business transaction on an accrual basis. So it's very important that we follow all these rules and regulations so that we get the consistency in the financial statements all across all companies and all countries.